Hello folks, welcome back to the channel. In this video series, we are going to conduct a qualitative review of Indian startups and their financials and also talk about their valuation. And this video is about Swiggy, the food delivery company based out of India. Before we dig too much into the analysis and paralysis of Swiggy and the valuation, let me deliver you the verdict straight away. Between red, green and amber, I'll call Swiggy an amber company, a high value company with its own set of issues which drags the company away from the green spot. This video is split into 4 parts. Number 1 is a review of qualitative and financial aspects of the company. Number 2 is the fundraising activity review. Number 3 is financial projection and the method to arrive at the valuation of the company. And number 4 is the peer comparison. And each section is timestamped in the description of the video for you to easily navigate across the video as in whatever you want. Now let's get into the groove. This topic of valuation behind startups generally draws very polarized views from people. One faction harps upon the potential while the other points out on the lack of profitability. This is an attempt to focus only on the numbers and try and make sense behind the valuation ourselves. Swiggy has grown 8.5 times in revenue between FY17 and FY19, and the trend is expected to continue. Also, company has identified ways to diversify its revenue by launching Swiggy Go and Swiggy Stores platform, and also by launching the private brands platform, which is expected to be the high margin business of Swiggy compared to the pure play delivery business. On qualitative terms, they have grown to delivering 500 cities from just 8 cities 3 years back, and delivering 1.4 million orders, which is 14 lakh orders per day compared to a mere 60,000 orders per day 2 years back. These are stunning growth numbers. Swiggy relatively is a late starter in the food business. Zomato was in the business 6 years before. Swiggy has been so successful that they made Zomato, which is a $600 million company before even Swiggy existed, catch up. What is alarming? The expenses are rising. Between FY17 and FY19, the expenses has risen from 338 crores to 3,659 crores. On a relative term, if you look at the graph, the EBITDA as a percentage of revenue, the negative EBITDA as a percentage of revenue has increased from 95% as on FY17 to 224% as on FY19. Basically, for every rupee of revenue which Swiggy makes as on FY19, it is losing 2.24 rupees. It is expending 3.24 rupees and it is losing 2.24 rupees. Swiggy is in the middle of an extraordinary cash burn cycle, which is unfortunately exacerbated by a strong competitor who is also in the cash burn mode, which is Zomato. Let's take a look at the valuation and the fundraising history of Swiggy. Swiggy was valued at $400 million in May 2017, and it is ballooned to $3.3 billion as on April 2020. At this, the compound annual growth rate, if you just put the math, it's around 100% growth rate per year. So in this process, Swiggy has raised around $1.6 billion of money, which Swiggy has been burning in the last 2 years. The primary VC funding is from Prosus and Naspers. Naspers is a South Africa-based internet company. Naspers' net worth itself is coming from 31% ownership from Tencent. Tencent is a hugely successful internet company based out of China. The market cap of Tencent would be around $500 to $600 billion if I'm not wrong. So the three companies, Tencent, Prosus Naspers. They have led multiple rounds of fundraising, and they have been the primary growth engine for Swiggy, who ensured that they've got the cash to keep burning in the last 2 years. And that is primarily the growth engine behind Swiggy in the last 3 years. Again, there is a small graphical representation out here to show how the fundraising has happened and how the valuation has increased for Swiggy in the last 2 years, funded by Prosus, Naspers and Tencent. Let's do a construction of P&L of Swiggy 5 years down the line. How 5 years down the line Swiggy's P&L should look for today's valuation to make sense. Obviously, this P&L construction has factored in the time value of money into its picture. So considering that, I've assumed a 70% growth rate, 70% compounded annual growth rate for Swiggy over the next 5 years, which projects the revenue of the company to be around 16,000 crores. At that, the kind of growth rate I wouldn't say is neither conservative nor too aggressive. If you look further, you'll realize that Swiggy's challenge is not so much to generate income. It is in fact the easier part, because Swiggy's demand today is completely justifiable demand, and it's expected to grow down the line. What is the difficult part? In 2024, I expect Swiggy to still be a super growth company. So let's assume that on 2024, Swiggy is trading at 100 times, Swiggy's value is 100 times its earnings, right? Taking that assumption, Swiggy needs to generate 402 crores of PAT to justify today's valuation. And to generate 402 crores of profit after tax as on 2024, Swiggy needs to generate an EBIT margin of 3.6%. Effectively, they have to return an operating profit of 574 crores on its 16,000 revenue as on 2024. Now, the problem that the Swiggy think tank needs to solve is, how do I go from a 224% negative EBITDA company to a 3.6% positive EBITDA company, right? So this is the graphical view which we are talking about here. From FY19 to FY24, the revenue can balloon in a linear fashion, but will the operating margins also increase from a negative 224% to a positive 3.6%? That is the difficult part. So now I thought of doing a peer review comparison of doing a comparative analysis of a company which is in the similar line of business. As you very well know, there is no listed company in India who is also doing the same business, the food delivery business. So I took a look at Naspers as to where else they have interests. Turns out Naspers has few other large investments in the food delivery market, and the most notable investment of Naspers is Delivery Hero. Delivery Hero is in the business of food delivery majorly in Europe, Canada, and some other countries in South America and Southeast Asia. DH is a public company listed in Frankfurt Stock Exchange, and hence I was able to access the financials of the company and do a comparative analysis. DH, founded in 2011, is 3 years ahead of curve compared to Swiggy, and is valued around $16 billion. In rupee terms, it's around 1.3 lakh crores. It is 5.3 times Swiggy's valuation as on date. But in terms of operations, if you look at it, it's still losing money, and pretty consistently. So you look at FY16 to FY19, it has lost around 50 to 60% of the total income that is generated in the period. So that is, if you look at FY17, they have made 454 million euro as revenue, of which EBITDA was negative 329 million. So EBITDA level loss is around 73%. EBITDA loss as a percentage of revenue is 73%. What I find interesting was, in Delivery Hero's annual report, it was classifying only the delivery expenses as core expenses and projected a gross profit of 25%. All other marketing and general operating expenses, including EBITDA, including employee salaries, were out of the core expenses. And if you consider all those, company's EBITDA loss was around 56% as on FY19. Now, that awkwardly reminds me of the ignominious community-adjusted EBITDA of WeWorks. Nevertheless, I try to understand the huge valuation of the company DH, which is steadily losing money at 50 to 70%, is expected to continue to lose money over the next 3 years till FY23, and is expected to turn the tide 3 years later from FY23. Now, I don't want to dig too much into this because we are not doing equity research of Delivery Hero. Let's try and take the understanding from Delivery Hero and apply it in Swiggy. And then let's assume Delivery Hero's understanding is correct because it's a publicly listed company. So many people are buying the shares today, and obviously there is a logic behind it, right? So let's apply that learning what Delivery Hero is going through today into Swiggy, which is still a private company. When I do that, I have two problems. Number one is Delivery Hero, even at its worst, was losing at the rate of 70% only. EBITDA was 70% negative compared to the revenue, while Swiggy's today's EBITDA is negative 224%. That's, at any scale, this is very, very far off, and that number alone makes it look like Swiggy is doing something wrong there. Number two, DH's story seems to be that of growth, and along with growth, fine-tune the margin over the period of time, right? Acquire market share and then start fine-tuning the margin. Now, while the concept itself is questionable, there is another layer of difficulty in applying this in Swiggy's story. Swiggy is able to grow at extraordinary rates because of its discounts, free Swiggy Super accounts that they are distributing, the very good incentive scheme that they have for the delivery personnel. Considering Swiggy's market is in India, can they still grow at the maniacal pace when it stops giving these incentives? So these two problems needs to be answered to make a fair valuation out of a $3.6 billion number. And hence, I am going to paint the board of Swiggy's canvas amber. Thank you very much.